welcome to LawWiser on Air. I'm your host, Alokita Tangri, and today we are unpacking a critical area for businesses operating in India, that is FEMA compliance. The Foreign Exchange Management Act 1999, better known as FEMA, governs cross border transactions and foreign exchange in India. While it's crucial for businesses, especially those with global operations, it can also be a complex compliance area with significant consequences for lapses. To help us decode this, I'm pleased to be joined by two esteemed guests. We have with us Ms. Jahnavi Upadhyay, Vice President, Global Legal at Accenture, and Ms. Pooja Sable, Partner at Desai and Diwanji. Thank you both for joining me today. So, Janvi,
Thank you for
let's
the
start
invitation.
with you. For the benefit of our listeners, could you briefly explain what is FEMA and why is it important for businesses operating in India?
Thank you, Alokita. The primary objective or purpose of FEMA is to facilitate external trade and payments and to promote orderly development and maintenance of the foreign exchange market in India. It focuses on management rather than regulation, unlike FERA, including a shift from restrictive to facilitative approach. The scope of FEMA is quite wide, but I'll try to summarize it. FEMA applies to residents of India, including individuals, companies, and firms, for their dealings in foreign exchange. The transactions involving foreign nationals or foreign companies doing business in India, and capital account transactions, including investment, borrowing, asset purchase, and current account transactions like trade, remittance, and service payments.
So let me just supplement what Janvi kindly introduced absolutely, correctly. And I'd like to just further divide it up into some segments, to understand how FEMA can apply. So as Janvi said, FEMA is very wide as a topic. So we're only covering, an introduction. In terms of what it regulates, firstly, it regulates foreign investment into India, right? Within that, it includes sort of downstream investments, which take place after foreign investment has come into an Indian company, and the Indian company further invests into another Indian company. And relating to foreign investment in India, FEMA also regulates all of the reporting requirements for any issuances of shares outside of India or transfers between residents and non-residents. Broadly, that's an important bucket. A second important bucket will be overseas investments from India to companies outside of India. So the overseas investments rules and regulations sort of govern for what purpose overseas investment can take place, what limits it can take place for example, it can only be up to 400% of the net worth of the Indian company who's making the overseas investment. And it also sort of sets out a lot of regulation in terms of what are the purposes for which overseas investment can be made. For example, it can be made for, expansion of foreign subsidiaries, but it cannot be made in the financial sector. It only has to be for, bona fide business purposes. It cannot be made beyond two layers of investments. So, right, that's the second bigger bucket of sort of regulation under the foreign investment framework and FEMA framework. Also, there are other buckets under which the foreign investment exchange regulation can, fall. So there are external commercial borrowings where Indian companies require commercial borrowings from foreign banks or lenders. So there is a lot of regulation in terms of for what purposes these ECBs, as they call it, can be availed. What are the sort of end uses and what is the all-in cost requirements for these, as well as who are the permitted lenders or borrowers in this situation. And also, of course, there are other buckets where individuals can sort of remit money outside of India through an liberalized remittance scheme. So up to 250 million USD can be remitted by individuals for specific purposes. And, as Janvi will agree, there are many other sort of areas where FEMA regulates, for example, setting up of liaison or branch offices, project offices in India. So these are the sort of main areas that FEMA regulates, and we can speak further based on more questions that you will bring up to us.
Sure. So, Pooja, could you also tell us what are the key compliance requirements under FEMA that companies should be aware of?
Definitely, yes. So firstly, I think the most critical compliance requirement is ensuring that you're falling within, an automatic or an approval route, because the filings or the compliance requirements will largely depend on that. So, of course, if you're under the automatic route, then the set of compliances for a foreign investment into India are usually filing of regulatory forms as soon as the investment is made. So it could be through a primary investment or an investment where issuance of shares is made outside India. Then the Indian company is obligated, or the Indian party is obligated to make a filing with their AD bank, which is Form FCGPR. And this should be filed adequately along, with the relevant attachments that are required, and pricing guidelines have to be met. So, these type of compliances are attached to issuances of primary investments into India. Whereas for secondary investments, where either resident or a non-resident are selling shares of an Indian company to each other, then the filing requirement of Form FCTRS kicks in, where they're required to report this transfer along with requisite attachments, such as, for example, the AD Bank will require a foreign inward remittance certificate, board resolution, the SPA in certain cases, and the like. So these are compliance requirements for foreign investment in India. When it comes to overseas investment, again, similarly, when you want to make an overseas investment, you will have to report the investment in Form ODI and an annual reporting as well. And cumulatively, a company needs to also file foreign assets and liabilities return every year to report entire foreign exchange transactions in the company. So these are broadly sort of the compliance requirements. But of course, as we covered other buckets of regulation, for example, external commercial borrowings or setting up of liaison offices and the like, all of these carry similar reporting requirements.
So, as Pooja said, the key provisions relevant for the business are basically the foreign direct investment, which is FDI, external commercial borrowings, export and import payments, overseas direct investment, which is ODI, repatriation of profits and royalties, and then there is liberalized remittance scheme, which is LRS. So these are the other areas. So I think that sort of summarizes.
So, now, Pooja, could you tell us what are some common compliance mistakes or oversights that companies make under FEMA?
Sure. There are many based on, so many diligences that we undertake. We uncover all sorts of compliance mistakes. So, it varies depending on the growth stage of the company and the sophistication of the company in its growth story. So we've seen in smaller companies the sort of compliance mistakes are usually that the companies don't recognize the importance of maintaining their filings and their reporting, right? It's not to say that all companies don't do this, but we do see a fair few companies who don't make the FEMA reportings on time or don't make them at all, right? And that, of course, becomes very problematic at a later stage when they are doing their fundraising rounds, and then sophisticated investors are looking out for all of these very basic compliances. So, that's sort of one of the compliance mistake. The other is, of course, largely companies do maintain their foreign exchange filings adequately. But then a common mistake, what we see is they don't maintain, a record of the acknowledgement of these filings that are filed, right? So that they will just, if we ask them if they've done the filing, they'll just give us a unsigned sort of blank paper saying, yes, this is the filing we had done. But it becomes difficult to ascertain. And now that has been corrected by, the sort of introduction of a online forms portal where we can see the compliance, approval, and rejection sort of mechanics. So apart from the non-filing, some mistakes we do see during transactions is when there is foreign investment in India, parties remitting funds in INR from overseas, right? So this is something that is problematic because ideally, when there is FDI in India, either when a foreign company is buying Indian shares or from an Indian shareholder, they should remit funds in the foreign currency. Reason being that there is a requirement of a foreign inward remittance certificate when the currency converts into India. And this certificate is critical to make the foreign exchange filing for that particular investment. And because all foreign investments are, linked to a large extent to title risks associated with that investment, it becomes very critical that all these small issues are sort of taken care of. So one is about, remitting in Indian currency is a mistake that we have seen. In terms of overseas investment, sometimes we've seen the mistake of companies not accounting for the new layering rules, which have been introduced, where I think it has been prohibited that beyond 2 layers, you can't have a structure that has overseas investment, right? So there is a lack of clarity also where companies are not counting, certain layers and doing this calculation. So that's a common sort of ODI mistake that we see. Then also, sometimes we'll see companies not sort of uh, taking the foreign inward remittance on the correct closing board resolution date. So as I said earlier, the filings require board resolutions also to be filed. So sometimes if you have an inward remittance before your board meeting, then that will be caught up. And then, a small thing like that can lead to a sort of compounding requirement. So these are the common mistakes, that we see from companies. And of course, there are many others, but I thought I'll just touch upon, some of the more common ones.
Thank you so much for that. So you've covered the mistakes or oversights that companies make. Now, Janvi, adding on to that, we often hear the phrase compliance hygiene when it comes to FEMA. Could you break that down for us? And what does compliance hygiene really mean? And why is it so critical?
The compliance hygiene basically is your timely reporting of filing your ODIs and for filing for your ODIs, FDIs, ECBs, trade-related returns within the prescribed timelines. The reporting also of export proceeds realization within 9 months, that is a limit, has to be also taken care of. Proper documentation is to be maintained, like maintaining invoices, contracts, SWIFT messages, approvals, and remittance certificates for every foreign exchange transaction. Ensuring documentation aligns with RBI circulars and authorized dealer requirements, that is also crucial. The correct classification, like differentiation of current account transactions from trade services, from capital account transactions, like investment and loans, is also crucial. Using the correct purpose code in foreign exchange remittance is crucial again. The pre-approvals where needed, like obtaining RBI or government approvals in the sectors under the approval route or the restricted transactions is necessary. And the ongoing monitoring is also crucial, like regularly checking your limits. Example, your ECB borrowing ceilings, ODI caps, LRS limits, to avoid any kind of an inadvertent breach. It is crucial. Why compliance hygiene is critical? Like Pooja said, that it may lead to compounding. There are heavy penalties which are there. So you have to be very mindful of that. Yes, there is also a newspaper test, protection of your reputation and your bank relationships. Again, that get impacted, right? Once you get into that loophole, you get into that spiral of compounding. They prevent and to prevent also any operational disruptions. Non-compliance can result into blockage of remittance from frozen funds or delayed capital infusion. Um, to support your M&A fundraising, again, you have to be very careful about your regulatory filings.
Yes, so now next question is to Pooja. Now if we come to the operational side, could you tell us how companies can build strong internal systems to ensure consistent FEMA compliance?
Sure. So I think some of the companies already have these systems, of course, but I think based on, what I have seen over the years, it's useful if the company ensures that their CA or CS, who they usually entrust with this job, is sort of very routinely doing an audit of, the FEMA compliances that the company undertakes right from the very first foreign exchange transaction, because these are largely inevitable in businesses. So I think having that point person or even replacing that point person is very critical, because a lot of times we hear that, oh, there was a different person taking care of the compliance, pre 2020, so we don't know where these documents are, and then it becomes a large liability. So I think companies recognizing the fact that this is a very important part of their growth journey, and not something that can actually lead to very high costs and consequences in the future. So one is sort of ensuring that the right compliance officer is in place. Secondly, also, where companies are more routinely engaged in foreign exchange transactions. For example, there are companies that are routinely involved in exports of services, or routinely involved in providing loans and guarantees to their overseas subsidiaries. In that case, they probably have several foreign exchange transactions in a month. So, it's good for these companies to also do audit of their sort of foreign exchange transactions, either through their advisors or otherwise through external consultants, because then it's ensured that at the time that they're going in for a transaction, or the time that, suddenly a query will be raised from RBI, then, there isn't enough time at that time to correct any, old compliances, and deals tend to get stalled, or important investments and important projects tend to get stalled because of minor issues in the past, because typically foreign investors have very little sort of risk appetite for issues in relation to foreign exchange control laws. So I think these are the two suggestions that I have, having the right compliance officer and carrying out periodic audits to ensure that everything is in place. And then, it's really not that hard.
Thank you so much. Now, so I'll throw this question to both of you. This would be our last question. So, can you share a real world example or case study where poor FEMA hygiene led to major consequences, or where good practices paid off?
So I can give you one example, obviously on a no names basis, where in one of our sort of deals and audits, we saw that a company was sort of issuing guarantees to its third layer subsidiary overseas for loans that they were availing overseas, and they didn't think it to be a problem, because obviously the operations were all, in India, and these companies outside were simply sort of ensuring that, they set up and they sort of get their contracts. And then, there was a time when they needed further investment to set up some sort of manufacturing, and the Indian company released loans and guarantees. Uh, but what they did is that they released these guarantees through the holding company of the Indian company. So they didn't really think that that would be a problem. But under Indian foreign exchange laws, only an Indian party, which is defined to mean an Indian party which actually has investment in the overseas subsidiary, can issue a loan or a guarantee. So there were multitude of these loans and guarantees that had been issued sort of very unknowingly, and that led to, later sort of compliance audit, because, it did come out in the figures and numbers. And that led to, huge sort of back and forth with the RBI and the AD bank, and, a hefty bill if I may say, in the compounding order. So that was one of the sort of issues we saw, right? And in terms of good hygiene paying off, I think we see it in 6 cases out of 10 where companies have been, very promptly ensuring that all their filings and all their disclosures have been done. They have correctly assessed their approvals. And I think the best part about it is that all of their deals and their transactions, go off maybe 60% faster than other deals. And that's a huge implication, right, in terms of business efficiency, in terms of costs, lawyer fees. So, I think these are sort of the couple of examples I can let you know about.
It's very interesting. Thank you so much for that. And that brings us to the end of this podcast. Thank you, Janvi and Pooja. And that's all for today's episode of LawWiser on Air. Until next time.